and then Bitcoin was, soaring in 2021. But then that went through a pretty big consolidation, and gold built a pretty big base, and then eventually broke out of it. So I could see a 12 to 18 month period of time where maybe Bitcoin is the place to be. But then the next 12 to 18 months, that story might reverse again, and maybe Bitcoin's overdone and gold consolidated, and I'd be pretty bullish gold again. So I just like to hold both and kind of emphasize one over the other, given what I'm seeing in, valuation, sentiment, market positioning, that sort of thing.
Hey guys, welcome to Everyday Finance with prominent speakers like JD Vance, Michael Saylor, and members of the Trump family figures traditionally associated with volatile market movements, tending a significant Bitcoin conference in Las Vegas this week. Traders are on edge. Singapore-based QCP Capital observes that Bitcoin volatility is still high, with prices fluctuating between about $17,000 and $110,000 over the previous 12 months. Last year's Trump speech caused a 30% decline in Bitcoin, which influenced the current cautious stance. Early Wednesday saw Ethereum rise more than 3% due to growing institutional interest and renewed confidence in its long-term potential. Bitcoin remains stable at about $19,000. Financial analyst Lyn Alden talked about Bitcoin's resilience in a recent interview with Jimmy Connor. She described how the cryptocurrency survived a turbulent 7 months, dropping from about $73,000 to about $50,000 due to currency shocks, rising to about $18,000 after the election, and then reaching all-time highs above about $110,000. Alden points out that Bitcoin's price is currently only slightly higher than its close from the previous year, indicating continued consolidation despite this upswing. She thinks that as adoption grows, Bitcoin's long-term trajectory will continue to rise. In contrast, gold has also experienced significant movement, rising quickly before leveling off. Don't forget to like, subscribe, and enable notifications. For more in-depth macro to crypto coverage, more insights from Lyn Alden's interview will be revealed soon.
So I'm still bullish with a 12 to 18 month view, and beyond. We'll see where we hit this cycle. Um, I would be surprised if we don't see 150K over the next 18 months or so. Um, there are scenarios to get you much higher. If you have a bunch of these leveraged Bitcoin entities coming in, and you could see a pretty big price swing, but then you probably have a crash after that. But at the current time, when I look at different metrics of valuation of sentiment, this is still kind of a quiet all-time high. It's not a euphoric type of all-time high. We basically went through 6 months of consolidation. So yeah, if you go back even further than that, I mean, March 2024, we hit new all-time highs. That was kind of on the back of spot ETF launches. So that got a little bit frothy. And then the market spent 7 months working off that valuation excess. So the Bitcoin chopped around for 7 months. It dipped as low from say 73,000 to like 50,000 briefly during the kind of the yen carry trade kerfuffle that was happening at the time. Then the election gave it another kind of second wind. We saw Bitcoin surge up to something like 108,000 in kind of late 2024. And really ever since then, it's been going through this consolidation. It fell as low as 75,000 briefly intraday. And now it's back to new all-time highs. It touched over 111,000. I don't know what it is at the time of this call, but it's at fresh new highs. But that's after a pretty big consolidation, and it's not that much higher than it was when it hit 108,000 late last year. I do think it has higher to go. Um, and I've been, long-term bullish on Bitcoin, long-term bullish on gold, and long-term bullish on select equities, because these are some of the ways to protect yourself. Is it's owning things that are scarce, that are not at bubble valuations, and then you kind of analyze them based on their metrics. If it's money, you analyze it one way. If it's equities, you analyze it another way. If it's real estate, you analyze it another way, and so on and so forth. So I'm generally bullish on things that are scarce and reasonably priced.
Okay, so what's your target price on gold in the next 12 to 18 months?
So I'm a little more concerned around gold in that time period, just because we already had a pretty big run for gold. So I wouldn't be surprised to see a say a 12-month consolidation before moving higher. I'm kind of purposely not trying to trade around that view, um, because I could certainly expect more consolidation, and it just kind of does another leg higher. So for me, it kind of shifted more from a buy to a hold. Um, the last time I kind of had this view was back in 2020. So in early 2020, gold had a pretty big run after the initial stimulus. Um, and I kind of wrote at the time that I think it could pause here and we kind of see a rotation of Bitcoin for a period. And that's generally what happened. And then Bitcoin was, soaring in 2021. But then that went through a pretty big consolidation, and gold built a pretty big base, and then eventually broke out of it. So I could see a 12 to 18 month period of time where maybe Bitcoin is the place to be. But then the next 12 to 18 months, that story might reverse again, and maybe Bitcoin's overdone and gold consolidated, and I'd be pretty bullish gold again. So I just like to hold both and kind of emphasize one over the other, given what I'm seeing in valuation, sentiment, market positioning, that sort of thing.
High stakes geopolitical maneuvering that sent shockwaves through global markets has sparked Bitcoin's most recent rally, which has been nothing short of explosive. The first catalyst was the proposal by former President Donald Trump to impose high tariffs on imports from Europe. It's caused Bitcoin to plummet due to uncertainty, but it quickly recovered after the policy was abruptly postponed. The July to June implied volatility spread on Bitcoin briefly surged above 2 before plummeting below 1, indicating that traders are now preparing for another significant move. This swift reversal fueled extreme volatility. Now all eyes are on the core PCE inflation data, which is a crucial indicator that has the potential to significantly change the Federal Reserve's position and set off another round of market movement, either upward or downward. Institutional conviction is unwavering despite the upheaval. A rare 30-day run of net inflows was recently recorded by BlackRock's Bitcoin ETF, demonstrating that major players view Bitcoin as a useful tool for managing macro uncertainty rather than as a speculative gamble. This is more than just a price recovery. It's an obvious indication that Bitcoin is growing into a key component of the larger financial system. Right now, the only real question is not if Bitcoin will move, but rather how drastically it will change the market going forward. Let's explore some additional findings from the interview with Lyn Alden.
Well, sound money basically refers to slower money supply growth, the idea that your money is going to hold its purchasing power, which by extension means that your contracts remain static. One of the kind of everybody thinks of savings when they think of currency debasement, savings being inflated away, but it's also contracts. Every business contract, basically a supplier contract, we're going to supply widgets for the next 6 months at this price, or I'm going to work for a company for the next year at these wages. Um, and all of those are contracts between various private entities. And when inflation happens, it basically tips the scales on one side of that contract. And so anyone kind of making those contracts has to think, I mean, is money supply going to go up 7% of next year or 20%? I mentioned before that I spend part of each year in Egypt. They've got money supply growth at 25 to 30% a year right now. Historically, it's been 20 some percent. Now it's been a little bit elevated. So imagine making a contract denominated in a unit that the supply of that unit is increasing by 20, 25, 30% per year. If you're the one earning those wages, or you're the one supplying real world goods at fixed prices for a set period of time in that currency, that's very damaging. Um, in broken money, I generally don't argue that we need like a movement to return to sound money. I view it as like technological determinism, that in this period of time, it's very hard to have sound money, and really the only way is to kind of introduce alternatives that gain market share and watch these current structures kind of work themselves out. I mean, Japan is far into fiscal dominance. The US and Europe are gradually entering fiscal dominance, and they're kind of at the stage of their maturation process where they've already burned up a lot of their capital. So this isn't, 50 years ago where they had low debt to GDP. They have very high sovereign debt to GDP, and there's really nowhere else to push it other than toward the currency. When you have a stock market bubble blow up, you can push it to the real estate market. When the real estate market blows up, you can push it to banks. When the banks blow up, you can push it up to the sovereign level. But the sovereign level, there's really nowhere to go other than inflate it away through debasement. And I think that's the age that we're in for developed countries around the world. Well, I think at this level, the dollar's still overvalued. If you look at the dollar over the past 50 plus years, so ever since the early 1970s, it's only gone through three major cycles. So there's been like three major bull markets in the dollar, and there's been two major bear markets because we're still in kind of the third dollar bull market, meaning that from 2014 to the present, it's been in a pretty strong dollar environment, meaning it's squeezing emerging markets and their dollar-denominated debt. It's worsening the U.S. trade deficit. 100 on the Dixie is still basically expensive. If you look at, for example, the Big Mac index or other measures of purchasing power parity, the current dollar level is quite expensive. Whereas, for example, the yen is on the cheaper side of things. Um, and I kind of expect we're going to chop around for a period of time. The U.S. still has a pretty big interest rate differential with Europe, for example, and the euro is a really big part of the DXY basket of comparison. Similar thing, we have a pretty big yield differential between the U.S. dollar and yen. And so I don't necessarily expect us to rapidly drop from here. A lot of that was just kind of unwinding that pretty quick move from, 100 to 110, and we kind of just round tripped a lot of that. But I do think that as we look out, say maybe 3 to 5 years, I kind of expect another significant dollar bear market. I think probably the third dollar bear market of its the lifetime of the current system, which goes back to the early 70s. So I wouldn't be surprised to see a 20+% drop in the dollar compared to other currencies. It's just not necessarily something I'm looking forward to in the next 3 to 6 months. I think it probably needs to settle for a bit, and then maybe we'll look into to lower lows. So I don't mind equal weight S&P 500. I'm a little aware of the big concentration in some of the biggest stocks. And I do think that foreign equities are more interesting at the current time, but I do have a broad swath of equities in my portfolio. Generally, what I expect is probably multiple years of chop, which is, we could very well hit new nominal highs, depending on what inflation ends up being. But I think that the return profile that people got over the past 40 plus years of ever falling interest rates, ever higher stock valuations, I think that period is behind us. And that, while there are plenty of good investments out there, the S&P 500 could certainly hit new highs. I think it's going to be just more lackluster. So I think that the fiscal dominance does a lot to prevent major drawdowns. It's pretty hard to kind of rapidly drop in asset prices when you're running sustained deficits and monetization of this scale. Um, but you can certainly drop for 20+% for a period of time, but then it finds a floor and then kind of keeps grinding up. So I think that we're in a period of weaker real returns for the foreseeable future until we work out some of the valuation excess or until we enter maybe a new market regime. So I'm neither particularly bearish nor particularly bullish. But there are pockets of the world that I'm more bullish on, and there are certain emerging markets that are super cheap. And this is kind of their first window of potential outperformance for quite a while. It's been a losing trade to bet against the large U.S. growth stocks and to really be anywhere else in the world. And I think this is a pretty good window to reverse that. I'm not 100% sure that's going to happen, but I think the probabilities are higher than they have been for quite a while. I wouldn't be surprised in 10% in either direction. Only outside of those bounds would I be somewhat surprised. And then I'd have to know what the headlines are because I can't predict ahead of time what's going to happen with the trade war. Maybe that heats up again. Maybe it doesn't. But I do think that margins are more pressured now for US stocks. Not necessarily that they're going to go down, but they might stop going up for a period of time. A lot of things are happen on the margins. So things don't necessarily need to reverse. They just need to stop going in a certain direction for major changes to happen. And so, for example, just margin expansion could be a thing of the past. And then you could give some of those margin points up, but even if you just stay where you are in terms of margin and you're no longer going up in valuation because you're no longer benefiting from a tailwind of ever lower interest rates, um, I think that's kind of the phase we're entering. So that's why I expect a generally more stagnant market with pockets of opportunity. I mean, I'm kind of public that I'm actually kind of bullish on U.S. financials at the current time. Ironically, as the U.S. kind of enters a slow motion fiscal crisis, um, the one of the winning sides is kind of the private sector financials because the everybody's kind of like fighting the last battle of wondering, what banks are going to be in trouble or are we going to have a big credit event? And we'll certainly have pockets of credit event, that's inevitable. But I think the biggest one is on the sovereign level, and that tends to be pretty decent for the private entities in the ecosystem.
According to Lyn Alden, the Big Mac Index and other purchasing power parity measures show that the US dollar is overvalued and the Japanese yen undervalued. Higher US interest rates attract global capital compared to Europe and Japan, strengthening the dollar. She expects the dollar to trade sideways after its recent rally and pullback. Over the next 3 to 5 years, the dollar could enter a significant bear market and lose over 20% of its value relative to other major currencies. A pattern repeated since the 1970s, Alden suggests profit margins may have peaked in U.S. equities. Predicting a flat or sideways market, though a crash is unlikely, the era of rising margins due to falling interest rates appears to be over. Due to strong capitalization and low valuation, U.S. banks and financials are appealing. Government spending exceeds revenue, creating fiscal dominance that could indirectly support the private sector, even as federal finances weaken. Alden expects Bitcoin to reach $150,000 within 12 to 18 months, stabilizing near all-time highs after significant volatility. She sees Bitcoin and other rare sound assets as powerful wealth preservation tools in an uncertain macro environment. Gold may consolidate after its recent spike, but remains a valuable long-term asset, with investors likely to switch between Bitcoin and gold, depending on market conditions. Bitcoin or gold, which will be the ultimate store of value? Write in the comments, like and subscribe, and stay tuned for more insights.